Okay, these are the T accounts with the opening balances. In problem 19, it was their first month of business. This company's been in business, so these accounts, all balance sheet accounts, all permanent accounts, have balances in them. We'll have to add to them as we need. Remember, as an accountant, you have a whole back pocket full of all the T accounts you need. Just throw them down as you need them. So, let's take a look at our transactions. And we're going to go off of this transaction sheet that we did in requirement 1. We have accounts receivable of $20,000. That's a debit to accounts receivable of $20,000 and a credit to service revenue of $20,000. So we need a new account there. Revenue, $20,000. And then on September 8th, again referring back to these transactions, on September 8th we purchased equipment for $21,000. So that's a credit to cash for $21,000 and a debit to equipment for $21,000. Just going right down that same list, we purchased supplies on September 12th for $3,500. And we purchased them, so that's a debit to supplies, but we purchased them on account, so instead of putting them under cash, we would put them under accounts payable, $3,500. Then on the 15th, we paid salaries. We don't have that T account, we need that. Salary expense, and that's a debit of $4,200 and a credit to cash of $4,200. And then on the 19th, we had that advertising expense of $1,000. Again, we need that. Add expense, debit $1,000, credit cash $1,000. Then on September 22nd, we paid our rent. We don't have that, so we need to add that rent expense. And these are all income statement accounts, so they wouldn't appear on the post-closing trial balance, so they wouldn't carry forward to the next period. That's why we have to add all of these. So our rent expense is $5,400, and we paid it, of course, in cash. And then on the 26th, we received $15,000 worth of cash from our accounts receivable. So we credit accounts receivable and debit cash for $15,000. And the last transaction of the month, we get some unearned revenue, deferred revenue. So it's either unearned or deferred. They mean the same thing. Unearned revenue is a liability, $6,000, and our cash is $6,000. So that's all of our T accounts. And then we go through and we'll balance them just like we did before. Add up both sides, write the little number under the big number, subtract the little number from the big number, write the answer under the big number. So when we do that, adding up both sides for cash, we come up with a cash balance of $35,500. When we do the same thing for accounts receivable, and I'm just going down the list, okay, in our accounts receivable, we come up with $6,700. Supplies, we take a look at our supply account. We have $4,000. Accounts payable, we have $4,700. And equipment, we have $28,400. And that's it. The rest are the regular balances. These are the balances that we will carry forward to part 3, which is completing the trial balance.